The word crash terrifies most investors. When the stock market starts falling, headlines scream panic, social media explodes with fear, and people rush to sell everything. But here's the truth that only the wealthiest investors truly understand: stock market crashes are not the end, they're the beginning of opportunity. If you play it right, a crash could be your ticket to becoming a millionaire. Today, we'll dive deep into why market crashes happen, how smart money reacts differently than the crowd, and how you can use a market meltdown to build generational wealth. So grab your notepad, because this is the kind of information that most people only realize after it's too late. Chapter 1. The fear that makes people poor. Every major financial crash, from the Great Depression in 1929 to the dot-com bubble in 2000, the 2008 financial crisis, and the COVID-19 crash in 2020, had one common element: fear. When fear hits the market, logic disappears. Stocks that were trading at premium valuations suddenly collapse. Quality companies lose 30%, 50%, even 80% of their value, not because their businesses failed, but because panic took control. The irony? These are the moments when the best opportunities are born. Warren Buffett, the world's most successful investor, said it best: be fearful when others are greedy, and greedy when others are fearful. During every crash, the emotional crowd dumps assets at any price, while smart investors quietly accumulate them at discounts that will look insane years later. The 2008 crash, for instance, was catastrophic for most. But those who bought companies like Apple, Amazon, and Tesla at the bottom turned every 10,000 investment into 6- or 7-figure portfolios within a decade. The question isn't if another crash will come, it's when. And when it does, will you panic like the masses or act like the millionaires? Chapter 2. Why crashes are normal and necessary. To understand why crashes can make you rich, you first have to understand why they happen. The stock market isn't a straight line. It's a cycle of optimism, greed, euphoria, fear, and despair. When prices go up for too long, people start to believe they'll never go down again. They take out loans to buy more stocks, pour money into overvalued companies, and ignore risk. Eventually, reality hits. Earnings disappoint, interest rates rise, or some global event shakes confidence, and suddenly, the bubble bursts. This burst is painful, but it's also natural. It's the market's way of resetting itself, like a forest fire clearing dead wood to allow new growth. If there were no crashes, there would be no chance to buy low. And without buying low, there's no path to becoming a millionaire. So rather than fearing a crash, you should prepare for it. Because wealth is transferred during downturns, from the impatient to the patient, from the fearful to the fearless, from the crowd to the contrarian. Chapter 3. The psychology of panic versus patience. Here's where 99% of people go wrong. When markets fall 20%, the average investor feels pain. When they fall 40%, they panic. And when they hit 60%, they sell everything, often at the very bottom. That emotional reaction is exactly what the big players want. When retail investors panic, sell, institutional investors, hedge funds, private equity, and billionaires quietly buy. They know that panic never lasts forever. They understand something called mean reversion, the idea that markets eventually return to their long-term average. History proves it. After the 2000 dot-com crash, the Nasdaq fell 78%. But by 2021, it had gained over 1,000%. After the 2008 crash, the S&P 500 doubled within 5 years. Even after the COVID crash, which was the fastest in history, the market reached all-time highs within 18 months. Every crash is temporary. Every recovery has been bigger than the last. So when the next crash hits, instead of asking how much could I lose, ask how much could I gain by holding through the storm. Chapter 4. The secret strategies millionaires use during crashes. Now that we've talked mindset, let's get practical. How do millionaires actually make money during a crash? 1. They keep cash ready. Cash is like ammunition in a bear market. While most people invest every dollar during bull runs, the rich keep some cash on the sidelines waiting for panic discounts. When the crash hits, they buy assets at 30-70% off their real value. It's the financial version of a Black Friday sale. 2. They buy quality, not hype. Millionaires don't chase meme stocks or hot trends. They focus on companies with strong balance sheets, consistent cash flow, real products, and loyal customers. Long-term competitive advantages. Think of companies like Microsoft, Vendia, Google, and Berkshire Hathaway. These are businesses that survive every storm. 3. They use dollar cost averaging instead of trying to time the bottom, which is impossible. They invest small amounts consistently as prices fall. This strategy, known as dollar cost averaging, automatically lowers the average cost per share, setting up massive gains when markets recover. 4. They diversify intelligently during a crash. Not every sector recovers equally. While tech might drop sharply, defensive sectors like healthcare or energy often bounce back faster. Millionaires diversify across sectors, geographies, and even asset types: stocks, real estate, commodities, and crypto to balance risk and reward. 5. They stay patient. Perhaps the most powerful strategy is patience. Millionaires understand that time in the market beats timing the market. While others chase quick profits, they build long-term wealth through compounding. Chapter 5: Real examples of crash millionaires. Let's bring this to life with real-world stories. Example 1. Warren Buffett. In 2008, during the 2008 financial crisis, when banks were collapsing, Buffett invested $5 billion in Goldman Sachs. People thought he was insane. Within a few years, that investment earned him over $3 billion in profit. Why? Because he bought fear and sold confidence. Example 2. The tech crash opportunists. In 2002, after the dot-com bubble burst, Amazon's stock fell from $113 to just $6. Investors who bought then and held saw their investment multiply by more than 500x over the next 2 decades. Example 3. The COVID-19 market whales. When COVID crashed markets in March 2020, billionaires like Cathie Wood and retail investors using apps like Robinhood started buying quality stocks. By mid-2021, their portfolios had doubled or tripled. Those who panicked, they sold at the bottom and watched prices soar without them. The pattern is clear. Every crash is a test of your emotions, your patience, and your discipline. Those who pass become millionaires. Chapter 6: How to prepare for the next crash. You don't need to be rich to get rich during a crash. You just need a plan. Here's a step-by-step checklist to prepare for the next downturn. Educate yourself, understand what you're investing in. Don't follow hype or social media tips. Build a watch list. Identify 10 fit and quality stocks you'd love to own at lower prices. Keep an emergency fund. Never invest money you can't afford to leave untouched for 3-5 years. Hold some cash. Liquidity gives you power when others are desperate to sell. Automate investments. Set up recurring buys so you stay consistent even when emotions rise. Control your emotions. Remember, fear is temporary, opportunity is permanent. Think long-term. If the company's fundamentals are strong, hold on. Markets recover always. When everyone else sees disaster, see a discount. Chapter 7: The hidden advantage of crashes. Compounding. Compounding is the silent engine behind every fortune. When you buy stocks during a crash, you're not just buying low, you're accelerating your compounding potential. Let's say you invest $10,000 during a crash in a stock that rebounds 100% over the next 2 years. You now have $20,000. If that continues compounding at just 10% annually, in 20 years, that same investment becomes over 1 with 0. Now imagine repeating this strategy across several crashes throughout your lifetime. Every market downturn becomes a wealth-building event, not a setback. That's how millionaires are made, through decades of compounding, powered by courage when others feel fear. Chapter 8: The mindset shift. From fearful to fearless. To truly benefit from crashes, you must reprogram your mindset. Most people react emotionally to falling prices because they associate red charts with loss. But seasoned investors see those same red charts as on sale signs. It's not easy. Fear is human. But the difference between losing and winning in the market isn't intelligence, it's emotional control. If you can learn to stay calm, rational, and strategic when everyone else is panicking, you've already joined the top 1% of investors. The next time markets crash, repeat this phrase: this is not the end. This is the opportunity I've been waiting for. Chapter 9: Why now might be the perfect time. As of 2025, the global economy faces major uncertainty: inflation, geopolitical tensions, rising interest rates, and slowing growth. Many analysts are warning that another market correction, even a crash, could be on the horizon. But for those who understand the patterns, this isn't bad news. It's a signal to prepare, to build cash reserves, to identify opportunities, and to get ready for the wealth transfer that always follows panic. When the crowd runs for the exit, the bold step in. And that's when millionaires are born, not in bull markets, but in bear markets. Chapter 10: Final thoughts. Your millionaire moment. Let's be real, becoming a millionaire from a crash won't happen overnight. It requires patience, strategy, and conviction when everyone else doubts you. But if you take this lesson seriously, if you stop fearing market crashes and start understanding them, you'll be light years ahead of 99% of investors. Because history doesn't repeat, but it rhymes. And every rhyme has the same rhythm: boom, crash, recovery, wealth. The question is, where will you be during the next one? Running with the crowd or walking the millionaire's path? So next time you hear the market is crashing, don't panic. Smile. Because if you're prepared, a crash could be your chance to build the fortune of your lifetime. Remember, the stock market crash won't make everyone a millionaire, but it will make someone one. The only question is, will it be you?